All right. Good morning, ladies and gentlemen. This is Tony from MacroAce and also the head financial analyst, FinancialJuice. So we've got a little bit to cover with the Bank of England. We've got about 30 minutes till we get the rate decision at 7 a.m. Eastern time. But let's go through some of the sentiment, what's happened with the Bank of England so far, what have they said, what happened in the last meeting, where is the economy at the moment, and then look at the deviations. All right, so let's get into it then. So what is it? So of course the bank rate is the rate the central bank pays interest to commercial banks. Of course, if the economy is doing really well and the central bank is able to afford a high rate of interest or thinks that the economy can deal with a high rate of interest, then of course they'll pay those commercial banks parking their excess reserves at the central bank a higher rate of interest. So that's one other thing to be aware of. Then why is it important? Of course, just like I said yesterday with the FMC and the Federal Reserve, of course, the same thing with ECB later on today. With a high rate of interest, that is usually done to slow down growth or make sure it doesn't get too out of hand. Also, particularly with inflation at the moment within the UK, and also how energy prices and the Russia-Ukraine conflict has affected that part of inflation. But then you also have the other side too, which if you lower rates or start to cut rates or continue cutting rates, that's used to support growth or create growth within an economy that might be faltering or that might be coming out of a deep recession or just trying to boost growth if the economy is staying stale or not really progressing that much. That's also, and then of course, the wider aspect is, of course, for businesses as well, with that growth, if they're able to, if you do lower interest rates, that it makes it easier for businesses to borrow money to provide more services or make goods and to consumers and also other businesses too. But of course, if you do raise interest rates, like I said, you slow down growth and those businesses will have to pay more back for their current loans that they have, or it'll cost them more money to take out a loan. And for consumers too, if they're facing higher rates of interest, then you've got mortgages to think about too, and then of course the products that they pay for. So that's the key thing as to why it's important to keep an eye out for. Of course, with the effects of Brexit, it does make it less important compared to the Federal Reserve and the ECB, but it doesn't mean that it's not important altogether, because it does cause some decent moves in the markets when there is a surprise or things don't go the way markets would have expected, whether it be better or worse the markets expect. So it's still quite a volatile release and can cause some nice moves if things go in a certain direction. Now, of course, as I said, affects banks handing out loans, mortgage and credit. Then where is the economy at the moment? So unemployment rate remains unchanged at 3.7%. Employment change also remains unchanged. The 27,000 jobs were added at the last year, towards the end of the year. Inflation also slightly down to 10.5% versus 10.7%. Still in the double digit, not like where it is in the ECB, where it's now gone down to single digit figures. But it does show that there is a bit of a slowdown in inflation, albeit not that much compared to what we've seen within other areas like the Eurozone or in the US or Canada. Average weekly earnings as well was higher than the previous at 6.4% compared to 6.1%. That's also another key measure for the central bank. is making sure that there isn't a wage price spiral to the point where if workers are receiving higher wages, then they will be able to spend more money on the same amount of goods in the economy. If there isn't more productivity that accompanies that. And we've seen the GDP data being worse than expected in Q3 at minus 0.3% compared to the second quarter of 0.2%. So, of course, that's another thing just to be aware of, that GDP data and the Bank of England had said that we're in a recession. So the economy does have a little bit of work to do to climb out of that, and maybe getting to the terminal rate sooner rather than later to focus on getting inflation back down from double digits into the single digits towards the central bank's target of 2% is what everyone has. Then, of course, at that point, then they can start thinking about supporting the economy in other ways. But that's not what's happening at the moment now. There are still risks to the economy that central bank members have highlighted, and they've made their vote, and they've relayed that through their votes that they've done with Dingra. You've had also Bank of England's Taylor as well, the other member, who decided that it would be better to go for to keep the rate unchanged because of the headwinds that the UK economy faces. GDP year on year was at 1.9% compared to the prior of 4.4%. And S&P Services PMI data we had this week was at 48 compared to the prior 49.9. So we're in that contractionary phase within the services side of the UK economy. Remember, the services side of the UK economy makes up the majority of the economy. About 80% of the economy comes through from providing services. We're not a manufacturing country anymore, as a lot of other countries do within the European Union. Of course, we're not in the European Union, but just making some similarities between, let's say, the likes of Germany. Of course, we're not as strong as Germany, but services sector is a very important part of the UK economy. Now, what traders and what analysts view as a recession in a certain sector of the economy, when they are looking at the PMI data, is at the 47 figure, where things are really becoming worse than expected, and businesses are faltering, and confidence is also down, orders are also down too. Those sort of things that can impact a PMI report. But then on the flip side, if we're looking, well, actually, no, on the flip side, on a similar note, if you're looking at the S&P manufacturing PMI, although we're still in the contractionary point, it was better than the prior figure of 46.7 at 47. So the UK economy has a lot of work to do to try and climb out of that. And the Bank of England, of course, understands that, but they have their big point of contention, or big point to deal with, which is inflation. So, and then retail sales, of course, how consumers faring too. Are they going in store to buy those goods, or online retail sales as well? It was at compared for the year on year, it was at minus 5.8% compared to the prior of minus 5.9%. So slightly better, but not great for the UK economy. So you can see it's quite bleak, the picture as represented. And you can understand why some of the central bank members may be feeling that continuing raising rates might not be a good idea. But of course, there is the exception that they need to get inflation down to the 2% target, or see substantial falls in inflation towards the 2% goal in order to kind of make any changes or shifts to their economic policy. So the previous statement and rates, so the key point that Dingra and Tenera made was that 3% bank rate is more than enough to bring CPI or inflation back to target, and there is no strong case to tighten on risk management grounds. Now, this is the problem. So you have the central bank members that are saying that 3% is enough to bring back inflation down. That could be true, but we'll have to wait for the next couple of inflation reports to kind of see whether or not it has actually come down substantially or not. And how long will it take for actually CPI to get back to, or get to the target of 2%? Will it take a year or more than a year to do that, or a couple of years, or however long, right? That really depends. So if we are still, not seeing huge drops in inflation, as other central banks have done, they've taken bigger steps to try and stop inflation from getting out of hand, to the point where they start seeing 0.5% drop in the headline or the CPI figures, or the headline figure of CPI year on year themselves, before they decide to, okay, now we can start to step back. We haven't seen that in the UK yet. We're still, as I said, we're still in double-digit inflation, which isn't great for the UK economy, for consumers or businesses. And also it's a big headache for the central bank. But again, Dingra and Tenmero being on the cautious side, which kind of rocked the markets a little bit in the last rate decision. Then comments from Governor Bailey and others as well we have to be aware of. Now, bearing in mind, there wasn't a lot of comments made from the last rate decision till now. They've been quite quiet. But just some of the key highlights to make from what's been said that are still important. So Pill, starting off with him, says that he sees higher natural gas prices posing a risk due to a tight labour market, adverse labour supply developments, and goods market bottlenecks. Also saying that the UK has the worst features of the US and Europe. So that's a high level of workforce dropouts and an energy supply crisis. So the UK economy, in layman terms, is screwed. Isn't having a great time. So that's one of the risks that was highlighted by Pill, but he didn't go for a rate, keeping the rate unchanged. Of course, he went in favor of the 50 basis point hike. So that still kind of shows you that, all right, yes, the UK has issues, but there is still a job to be done. Bank of England's Man, being one of the most hawkish members of the central bank, said that household and businesses anticipate 4% inflation in the coming years. We are not at risk of policy over tightening just yet. Okay, so Man being the opposite to Dingra and Tenro, and also to Pill in a way, saying that that there isn't going to be any sort of tailwind or big of a tailwind that's going to come through with us over tightening, or with us tightening our policy, because we haven't over tightened yet, because we haven't seen the effects on the economy take full effect. Right? Remember, it takes about a year or so, about 12 months, for interest rate hikes to take effect on the economy. So we've still got quite a bit of a ways to go with seeing how much of an effect these interest rates have had on the UK's economy. Then Bailey, on the 19th of January, said the most likely consequence is that this year's inflation will decline rapidly, most likely beginning in the late spring. So again, actually, a new point. Does that mean that the central bank or the Bank of England could go with a 50 basis point hike as a possibility? Okay. The idea of Man saying that they're no risk of policy over tightening just yet doesn't mean that they're going to stop hiking. It could just mean they could hike by a smaller amount, but that's not what's really expected. Bailey saying I predict a long but shallow recession. So even with these big rate hikes, remember 50 basis point hike is still quite big, right? It's not small compared to the norm of a 25 basis point hike. So him saying that I predict a long but shallow recession. So yes, there's going to be a loss of productivity and a little bit of pain, but that's going to be needed to get to a 2% goal. He's not also adding that he's not backing a 4.5% bank rate peak, but in December is that we did not include the comment about the market being, in our view, rather than out of step. So there is a market trying to anticipate where the terminal rate is going to be. Bailey is kind of having a bit of a tussle backwards and forwards with the markets, with the expectation where the rate is going to end up. We know there have been surprises by the Bank of England where the central bank is expected to maybe raise rates and then they don't. Okay, if we're thinking back to December of 2021, okay, when the central bank was expected to start to cool down or start to tighten monetary policy further from then, but they didn't. They decided to kind of carry on with what they're going to do with keeping the rate unchanged. So there are also those surprises there to kind of expect that could happen. So it's best not to kind of fight back against Bailey with pricing in where the interest rate could end up because of how he surprised the markets. But it doesn't mean you can't still do it because if they are going to go with one more, if they do decide to go with a 50 basis point hike this meeting and then at the next one go with a 25, you get to 4.25%, not the 4.5% bank rate peak, but you're close enough to it. So there's also that to kind of understand and just to be aware of, is that Bailey could surprise the markets. Maybe decide to go with a 25 this meeting. You never know. It's kind of harder to predict what the Bank of England is going to do compared to the Federal Reserve, because the Federal Reserve is very clear with how they kind of communicate through their central bank members of where they expect the policy rate to be, what they expect with providing forward guidance that way through the markets. Government views then. So you had UK's PM Sunak said it is not a certainty that we will reduce inflation. We must be disciplined. And then on the 6th of January, you had an FTP saying that all UK businesses will be given a discount on the cost of their power from spring. The overall package will be set at a lower level than the current 6 month long business energy package, which is set to cost almost £20 billion by the time it expires at the end of March. So the extra bit of spending that the government is doing, yes, there's going to be some addition to inflation, and it's going to be harder to reduce inflation. But for a UK consumer or the everyday or the average person in the UK, having some sort of support provided, or particularly the smaller businesses, some sort of support for those businesses will kind of help alleviate some of the pain, but it might make it harder for the Bank of England in the long run to reduce inflation. So this is so here we go. So you have inflation of how it's performed overall within the UK. So you can see here you've got goods inflation, which is still relatively high. And then you have of course you have your services here as well. So you are still, if we're still around this peak here, maybe we have peaked, right, with UK inflation kind of coming down, but we're not too sure yet because we've seen in the past where we thought we might have peaked and then we kind of level off and then we kind of go back up again and kind of dip down and we go a bit higher. So that's also the uncertainty there, is that how long do you let inflation run for, and then how much action do you take? So Dinger and Tenrero's decision to go with no change with how the economy is faring now, it makes sense because of the external factors that are taking place affecting the UK's economy, but those external factors are also impacting inflation, which you need to control first. You can't really control the external factors that much. That's not in the Bank of England's hand. In the Bank of England's hand is controlling the flow of money and, of course, setting rates wherever they need to set it at. Then if we're looking at the current expectation then for where the central bank members lie on the hawkish or dovish side, so you can see here Tenrero and Dinger. This hasn't changed from the last time around. It's still the same. Dinger and Tenrero on the holding side or on the dovish side, and then everyone else. And then, as I said, Man being the most hawkish member of the central bank. So, Bank of England panel survey on January 5th. We've got about 10 minutes to the release, by the way. So, you had the DMP members expecting inflation to be 7.4% 1 year ahead in December, up from 7.2% in November survey. Businesses expect unit costs to grow by 8.1% over the coming year, down from 8.6%, which is good. You don't want to see it costing a business to make a product. You don't want it to seem it costing them more to make a product than they actually need to, particularly how much, first of all, how much is the worker producing per hour, right? And does the revenue that they make from that offset the amount that they've paid the worker and the amount that they paid to collate or bring together the goods? And also the services too, as well, to kind of put that together. Of course, that also has its own unit costs that you've got to be, that businesses have to be aware of. Higher interest rates are projected to reduce investment and employment over the next year, according to businesses. And the Bank of England said inflation and wages worsen, or outlook for inflation wages worsen for businesses. That's expected. That's nothing surprising to the markets. If you're going to raise rates by a big amount continuously in a short period of time, it's going to happen where business activity is going to fall off and investment is also going to go down as well. Investment bank views. So traders on January 12th bet the Bank of England interest rate will peak below 4.5%. Traders trimmed their Bank of England bets to 4.43%, the lowest since September. 19th of Jan, you had a client strategy director from GfK, Joe Staton, saying with inflation continuing to eat away at salary growth and the threat of some stunning energy bills arriving shortly, one thing we can be certain of is that 2023 will be a rocky trip. MUFG's Lee Hardman said that retail sales have only slightly countered optimism from other economic indicators this week. A stronger UK economy would have put additional pressure on the Bank of England to deliver more rises. We haven't seen that with the UK economy. As I said, we're in the negative for GDP, so we're not out of the blue or out of the grass yet. We're still kind of stuck around in the tall grass, trying to find our way out, trying to cut down the inflation that we kind of see around us, or try and trim your lawn with the lawnmower is what Bailey's trying to do, and then just keeps rising in certain areas and trying to keep it down. That's actually a good analogy. If you're a central banker, you're trying to mow the lawn to keep the grass from growing too high and trying to keep it at a nice even level to make it look nice and pretty. I can just imagine that in a meeting with the Bank of England, all they're doing is just mowing a lawn the whole day. So then you had, according to Bank of America's Robert Woods, senior UK economist, and the Bank of England is going to have to maintain pressing down on inflation for quite a long time. The UK stands out as having the greatest issues in the United States and Europe, and the underlying pricing pressures and high wage growth indicate that this inflation is likely to last. So the Bank of England has a big problem, and they just need to keep pressing on forward and then kind of deal with the aftermath and see what happens. Markets also looking at another 50 basis point hike for February to take the rate to 4%, the highest since February 2008, and then another one by the third quarter. The first rate cut is not fully priced in by investors until February 2024. So a year later is when traders are expecting the central bank to actually start cutting rates. And that's probably going to be likely if there is a expectation of a recession. But if there is a deep recession expected, that could happen sooner rather than later. But it depends on how data kind of plays out. One, has inflation got down to the 2% or towards the 2% target, right? Nice and quickly. And second of all, what is employment data like? Is retail sales spending being hit worse? And then finally, what is GDP like? Do we see continuous negative bits of data from the UK economy? And then, of course, you blame the politicians because it's all their fault too. It's always fun watching the PMQs. Goldman Sachs, as Raja said, the UK is in a unique position due to stubbornly resilient underlying price pressures and yet to peak service inflation. They don't anticipate any rate decreases this year because inflation is expected to remain uncomfortably above the bank's 2% objective. So that's kind of more or less, we don't really explain what Raja said. It's more self-explanatory. So this is the last release that we had seen from the Bank of England. We've got about 5 minutes to the other release till we get the actual release. But the last release we'd seen on December 15th, you can see here, we'll see how the markets play out. And come comes through with the data. There we go. It was rate hike was as expected, but you had seen that there were 2 members that voted for no change, right? 7 voted for a hike. That's why the pound went down. Now, if we see the same situation again today, which is what the expectation is, it's not expected to be a surprise. You could still see some movement towards the downside if that occurs, if we get a 7-2 vote, right? So if I kind of just exit this and we'll show the deviations. We'll bring it up here. Okay. So this is what happened, right? So this is how the markets reacted. So GBP JPY had the biggest market reaction, okay? So you'd seen 53.5 pips down after about 10 minutes of trading. It was down by, from the initial market reaction, down by 13.6 or 13.5 pips. Okay, that's what the initial market reaction is here. Okay, going to the wick of the candle. This is on a 1 minute candle, by the way. And this shows you the movement 10 minutes after the release has occurred. Okay, going to the end of the candle. Always like to get the initial movement to see, how big the initial movement was, what you can kind of capitalize on, and then see how the market's fared 10 minutes along the line. So again, the key point there was that the prize was that Dingra and Tenrera voted to keep the rate unchanged. Now that's not expected to be a surprise. You could see that you could see a reaction where things might not see that big of a reaction, okay? If they does come out as expected that Dingra and Tenrera vote for no change, but if you get another member in addition, okay, who wants to vote for no change, right, then that could add to the fuel of sterling seeing some further weakness. The flip side to that scenario would be that Tenrera and Dingra actually flip and vote to raise rates not by 50 basis points, okay, but by 25 basis points instead. That's the other scenario that could cause some positivity for the markets, right? So you have all the members voting for a hike. The only difference is that you have 2 members voting for 25 rather than a 50. That could cause some positivity for the markets, or it could cause some confusion that the dovish members are still not towing the line with what the rest of the central bank wants to do. But the key thing to understand is that GBP JPY has had the biggest market reaction with GBP CAD and also we're looking at GP New Zealand dollar and GBP Aussie dollar. They had nice big reactions last time as well. So we've got GP JPY consistently, is what we can see here, has had a decent reaction in the past. Doesn't mean you don't leave out cable. Cable still has a nice decent reaction, what we've seen, but that's the key thing. So unless they do decide to hike interest rates by more than expected, if they do decide to hike interest rates by more than expected, then that could actually be much better for the market instead. But then if you do have members that are voting for no change, then that could muddy the waters a bit more. We've got less than a minute left towards the economic release. So remember, we want to keep an eye on what the voters are doing. Let's bring that here. Put that, whoops. Okay, 10 seconds. See what happens. $50 basis point hike, 50 basis point hike as expected. Seeing a whipsawing here on cable, or movement towards the upside. Okay, all right, there we go. So it was as expected with the voting as well. So again, markets were expecting that. Now looking to the comments then from the Bank of England. So if we kind of go through with what they have said here, if there were to be evidence of more persistent pressures, then further tightening monetary policy would be required. Okay, Forecasts show inflation in 1 year's time at 3%. November forecast was 5.2%. So again, pound seeing a strengthening there off of the back of the data. Let's see, inflation to fall, by fourth quarter. Also, seeing that they continue to judge inflation risk are skewed significantly to the upside. They see recession with just under 1% peak to trough fall in GDP over 5 quarters versus November forecast of around 3% fall over 8 quarters. So slightly better than expected picture for the UK economy there. Tenrera and Dingra voted to keep the rate unchanged. That's no surprise at 3.5%. So MPC no longer says it will respond forcefully on rates or that further increases in bank rates may be required. Okay, so Bank of England past increases in bank rate expected to have increasing impact on the economy in the coming quarters. CPI is likely to have peaked and now expect much shallower decline in output in 2023 than forecast in November. No return of GDP pre-COVID peak before 2026 at earliest based on market rates. Previously, November was seen after 2025. So they project a positive growth for GDP for the fourth quarter of 2022 compared to the forecast of minus 0.1%. They see a plus 0.1% and see minus 0.1% quarter on quarter for the first quarter of 2023. So market rates imply less Bank of England tightening than November. Show the bank rate of 4.4% in the fourth quarter 2023, 3.7% in the fourth quarter 2024. So there we go, giving a hint as to when what the markets are implying about where the interest rate will go. And then fourth quarter and 3.4% in the fourth quarter 2025, compared to a smaller rate path than the November projections. In November, they'd seen a 5.2% in the Q4 of 2023, 4.7% in 2024 Q4, and then 4.4% in the fourth quarter of 2025. Forecast show inflation in 3 years' time at spot 3%. November forecast, spot 3.7% compared to the November forecast of 0.02%. So significant move up there in inflation expectations. What else? COVID, Brexit, labour supply, and high energy prices have lowered UK potential supply growth for 2024-2025. That's basically about it. Okay, so UK gilt futures, this is market reaction. So UK gilt futures fall around 40 ticks after Bank of England raises interest rates. So what are the surprises there? Well, the only thing that they can talk about is they're expecting a slightly better GDP outlook for the UK economy. They're not painting a very dovish image with their expectations for the economy. Okay, the rate hike votes was as expected. So you had 7 voting in favor for a rate hike, 2 Dinger and Tenrera again. Those 2 guys are voting for no change. Other than that, you don't really have anything else to kind of look forward to. So you can see here that the markets, so you had the reaction from the 50 base point hike. And looking back at the screen now, you can hear me. Can you hear me? Louis, Stefano too? Maybe if you turn your sound up a little bit. Or I'll try and speak louder. But yeah, so Arctic Yam says, what do you mean by not expecting a surprise? Well, what the surprise is if when I say not expecting a surprise, is talking about what the voters do. Yeah. So who the voters are going to be and what they decide to, or what the voters decide to do. That's not a surprise. Dinger and Tenrero, the last time around, voted for no change. The markets were anticipating it'd probably do the same thing at this meeting too, which is what they did and what the markets were anticipating in the median forecast as well. See, they're expecting two members to vote for no change and some to vote in favor for a hike. And that's what happened. So the markets are okay, there are no surprises from that, right? The bank has raised their rates by 50 basis points. Sterling has appreciated. They paint a slightly better picture for the UK economy in the future. Not that it's absolutely great or smashing, but it was enough for sterling to see appreciation in the markets. So no big surprises, okay? And now you can kind of see the market going back in the opposite direction. Let's say George K says, I was long cable, realized there was a B of E decision 10 minutes and thought it'd be sensible to close before the hike. Well, good on you. Arctic Yam says, thanks, and thanks for the great content. Yeah, don't forget, I'm still going to be here. We've got the ECB. We're not done yet, We have still quite a long way to go. But yeah, so let's say if the central bank provided a more hawkish statement, okay, or rate statement, right, then we would probably see a stronger reaction from sterling, and we won't see this reversal that we're seeing here. But let's do some measurements here first, okay? Or if we get a less rosy picture and another central bank or maybe another central bank member voted for no change, then you would have seen a bigger amount of depreciation from sterling. But again, no surprises. A slightly better picture for the UK economy leaves sterling traders happy. So here we go. Let's look at cable, see how many move pips it made. So 57.8 pips there for cable. Okay, on the initial reaction. Let's look at GBP/JPY again, which has had consistently the biggest reaction in the markets. So that was 63.8, or if you want to say 64 pips towards the upside. What else? Let's do Euro GBP. Let's bring up. I also want to have a look at the Aussie dollar too and New Zealand dollar. See if it had, see how much those reacted as well, because they had a bigger reaction than the Japanese yen and sterling last time round. They had a bigger reaction compared to cable and the dollar GBP JPY last time round. That was 36.5 or 36.7. Let's get up GBP AUD. I have a feeling. Well, can't go off feelings, can we? There we go. It's already reversed it. So surely reactions have. Okay, so it has had a bigger reaction than the GBP JPY. That's 2 times in a row now, and that's happened. It's kind of changing. The only reason that would be. Let's have a little look. Look here. 71.7.5 pips. Excuse me, 71.7 pips. Okay. On GBP New Zealand dollar. All right, here we go. Some would say that you'd have GBP JPY that have the biggest reaction because of how the Bank of Japan has continued easing its monetary policy, but has started becoming a little bit more hawkish with expanding the yield band to support 5%. From spot to 5% as the max. But here we can still see that GBP Aussie dollar and New Zealand dollar, GBP New Zealand dollar are having, or has had the bigger reactions, or have had the bigger reactions within the markets there. So this is quite interesting. You've had, just looking at the past and what's kind of causing this movement. You've had in the past from the BNZ, now expecting the RBNZ to the RBNZ cash rate to peak at 5% rather than 5.5%. Okay, so this is more up to date expectations, but expect them to BNZ expect them to do a 50 basis point this month. So that's quite important if they're expected to reach their peak rate much sooner than expected. Although yes, they do have a higher interest rate than the UK. It's more or less the expectation that the RBNZ has kind of got to where they want to now or sooner compared to the Bank of England, which still has some more tightening to do. So that's the only reason that's why I can think of that there's going to be more appreciation or bigger movement in those currencies, in those currency pairs. Ooh. All right, so let's have a little look. So FinancialJuice. So what is FinancialJuice? So we've been looking at the data here. It came out nice and quick. So FinancialJuice is a live voice and text service. Okay, and if you think about big investment traders or the big banks, right? They have access to a live voice and text service, so they can understand what's going on within the markets and capitalize on the potential volatility or a headline that's come through that might be suggesting something different, or maybe there's something that's changed altogether. Okay, what's Hunt said? Hunt said that we will play our part by making sure government decisions are in lockstep with the bank's approach. Right, good. So live voice and text service is there to help traders first manage, capitalize on potential trades, manage their risk, right? Understand. Key thing is to understand why the markets are moving in a certain way. Okay, if they're seeing a bit of a big old job. If you are just looking at the charts, but you don't know why they're moving, well, have a live voice and text service for yourself. Understand what's kind of going on in the markets, and you can kind of make more of an informed decision as to what to do. It's all, but if that works for you, then great. Do that. That's perfectly fine. No one is going to stop you from doing that. But having a live voice and text service, so what's the benefits of having the pro version of FinancialJuice? So the light version of FinancialJuice, the free version, okay, the free version, you have adverts playing, you have a delay to the website overall, and you also don't get access to the news desk to ask questions about what's happening in the markets, or if there's any issues with the website that you're facing, or maybe any questions that you have. Okay, that's the difference between FinancialJuice Pro and the light version. Now, if you want the pro version of FinancialJuice, that's totally up to you. But first, if you do decide to go with the pro version, what you need to do from your side is, first of all, make sure that you've created an account on FinancialJuice first. Okay. Then once you've created an account, you've got your username and login. Then you can go check your email, verify your account, go back to the website, and it will come with a little button saying Go Pro. Once you've clicked on Go Pro, then all you got to do is, once you've paid for the product, go back to the website, log out, then log back in, and then go from there. Okay, so I'm going to pop in the link for you. Yes, we do have the Challenger layoffs in about 15 minutes. Yes, we do. You are right. Fuel the fission. But yes, that's the link to the website. Remember, create an account first, verify it. If you want to go pro, pay for it, then go back to the website, log out, and then log back in. And then you'll see what I'm seeing here. This beautiful website. So here you have your text headlines, or here, okay, you have your economic calendar here on the left-hand side. This is the live voice feed here as well. You also have TICKSTRIKE here as well, but not the full version. This is more like the free version, but it's limited. Okay, you don't get kind of chop and choose whatever you want to look at, and it's stuck at one level of sensitivity. So if we're also looking, so that's FinancialJuice. Now TICKSTRIKE, if you've been looking at it here, you've been seeing it move towards the upside, or a bit of buying or selling that's going on. I think there might be an issue with TickStrike at the moment. Okay, there might be. So TickStrike. So let me kind of explain. So when there's a bit of buying or selling, so TickStrike allows you to listen into order flow, okay, or how strong the buying or selling momentum is within different asset classes. That's forex, crypto, stocks, futures, ETFs and ETNs, and also internals like your VIX. Okay, how strong is the volatility index, right? There's all different things you can look at, and there's the way it's measured or the way it's represented. The measurement is this little number here, or let's say on this little ticker, this box, what we call here, where the 0 is. If it shows a plus sign with a figure, that shows you buying momentum, and then with the negative sign shows you selling momentum there. Now you can kind of chop and change. So 1 is the most sensitive to market reactions. So when there's a bit of buying or selling that goes on, then TickStrike will go off. But if you use the slider here on the left hand side, you can kind of chop and change to where you want that sensitivity to be. The highest point is 15. So if you get to 15, that's the least sensitive to market reactions. And only when there's a big amount of movement that is happening, then will TickStrike give you a visual alert, and also an audio alert too, right? An audio alert, I've kind of turned off the sound at the moment now, because otherwise you will have too many sounds going off. But we do need to sort that out. Apologies for anyone who's using TickStrike at the moment. We'll get our devs to work on it. But that's the link there for you in the FinancialJuice news feed for you to have a look at. Of course, we also have the Bank of England press conference too. Hey, happy days. It's going to be a busy, busy day. Like I said, we're not done yet. We've got the ECB interest rate decision coming up as well. Okay, so I'll be in about at about quarter to 8. I'll be kind of going through the ECB rate decision, and then we'll go through some ECB prep. But of course, the ECB being the more important, or the big one here. But don't forget, if you've liked this video, don't forget to subscribe to the channel, like the video, share it with your friends, share it with your family if they're into trading, share it with your dog if it knows how to press and type on a key, type at a keyboard, and put in positions. So always interested in understanding why the markets move in the way that they move. Wants to prepare themselves for potential market reactions. But yeah, there we go. That's it's 7:18 now. This is like a classroom. We'll be back in about 20 minutes or so. Okay, and I'm just gonna get some data sorted for the deviations. All right, I will speak to you guys in a little bit. All right, ladies and gentlemen, we are back. Back to do the ECB this time around, and then we'll call it an end to the day. Once we've gone through that, there won't be anything else for the rest of the day, other than tomorrow with non-farm payrolls. But let's go through the ECB rate decision. Don't forget to, of course, like and subscribe to the channel as well, and make sure you're following us as well on Twitter, on the twits. And also share this video as well to get the wider reach going. So, ECB then. Now, what is the deposit rate? Of course, that's one of the key rates. That's one of the key rates to be aware of, other than the main refinancing rate, which is the headline figure. But the deposit rate is something that people kind of put to the side, or don't understand too much, don't really understand how much of an impact it can have. So, it's similar to the Bank of England bank rate. The excess reserves that commercial banks have is parked at the ECB in return for the deposit rate, okay, in return for interest. Now, when that goes higher, that means that the central bank has more confidence in the economy or themselves to be able to pay the higher rate of interest back. And then what those commercial banks do as well is they, in step, raise their interest rates as well for consumers and businesses alike, in order to maintain and follow what the central bank has guided them to do with rates as well. So that's one thing to be aware of with the deposit rate as well. Of course, the main refinancing rate being the overnight rate that commercial banks pay to each other for taking out loans. So as I said, the deposit rate, as I said, where they place excess reserves, an interest rate that is usually 100 basis points or 1% below the main refinancing rate, and establishes the floor on the interest rate, since no bank will lend money out less than what it can earn the deposit facility. Then, where is the economy at the moment? So this is quite key to understand. So inflation being at 9.2% in the Eurozone. So, of course, that was the data beforehand, but now it's 8.5% compared to 9.2%. The data came out yesterday, so it's still, so you can see that nice deflation or disinflation, should I say, with the Eurozone economy coming in at 8.5% compared to the prior 9.2%. The S&P manufacturing PMI data as well, that was also better than. Also, the as I said, S&P manufacturing PMI data was at 48.8, so it's better than the prior data that we had versus the prior 47.8. And then if we're looking at the services PMI as well that we had from the Eurozone, it's at 50.7 compared to the prior 49.8. Now, usually when the figures are showing that it's at, if you are in the 50s figures, that shows the economy is in expansion, or anything above 50. Anything below 50 shows a contraction. So for the Eurozone economy in the services side, that's quite a good sign that businesses are feeling better about their outlook with orders, also unit labor costs and the hiring as well, and how much productivity that they're experiencing within their side. So that's quite good for the Eurozone economy. It means that the central bank can still be hawkish, or very hawkish, with the interest rate hikes that they've been doing, and expected to deliver 250 base point hikes today for the ECB interest rate, or the main refinancing rate, to 3% from the prior 2.5%, and the deposit rate from 2% to 2.5%. Okay, so that's what it's expected today as well. Consumer confidence was at minus 20.9 versus minus 22.2. Economic sentiment at 95.8 versus the prior 93.7. And the German IFO business climate data as well. Of course, with the business climate coming in better than expected at 90.2 versus the prior of 88.6. So that's one thing to just bear in mind, is that you have a slightly better picture painted for the Eurozone economy. But in the main economy of Germany being the strongest economy within the European Union, that's also something to just to be aware of as well. So that if Germany is expected to have a better business outlook, then the rest of the global economy, the rest of the European economy will be able to kind of follow suit or will have more faith that the Eurozone won't collapse if the major economy doesn't collapse and is actually shown to be doing better. And that's how investors kind of gauge how Europe is doing, how the European Union is doing too. If Germany starts to falter or starts to see a bit of a backward pedal, then it can be worse for the Eurozone economy and the expectations and traders' expectations for the euro. What the ECB's expectations are. Remember, a lot of the data that the ECB uses is based on what Germany is experiencing. Because if something happens in Germany that means that they're faltering, then they will need to change their policy up pretty quickly. Because then whatever happens in Germany will have a knock-on effect in the rest of the Eurozone economy too. So inflation at 8.6% for the year on year compared to 10% of the prior figure. Right, that was of course, the final data showing kind of data for the German CPI. And the HICP at 9.6% compared to the prior of 11.3%. So a marked decline in inflation overall for Germany, which is better news for the Eurozone economy. Then the previous ECB meeting then. What was said last time round? What was to keep an eye out for? So 50 basis point hike was taken as expected. The Governing Council judges that interest rates will still have to rise significantly at a steady pace to reach levels that are sufficiently restrictive to ensure a timely return of inflation to the 2% medium target. According to the latest Eurosystem staff projections, a recession would be relatively short-lived and shallow, and the asset purchase program portfolio will decline at a measured and predictable rate beginning in March 2023, as the Eurosystem will not reinvest all principal payments from maturing securities. So the key thing here is that the central bank is still willing to raise rates at a significant pace. Remember, 50 basis point hikes are not small. Okay, they're still big compared to the normal of a 25. And there's also the extra hawkishness of the ECB or Eurosystem staff projections saying that a recession will be relatively short-lived and shallow, providing a better outlook for the Eurozone economy than what traders might have been expecting, that the economy is going to take a bigger brunt of the hit from, one, the energy crisis, and two, these rate hikes that are also going to have an effect on the supply of money for businesses and consumers alike as well. So that's also another thing to be aware of with how the ECB, the last meeting, views the Eurozone economy. Then they also said they expect average inflation to reach 8.4% in 2022 before falling to 6.3% in 2023. So by the way things are looking, that's more than likely to happen pretty soon. They said that with inflation expected to fall significantly over the course of the year. So if that happens, then the central bank can reach its terminal rates much quicker than maybe what analysts or the central bank itself was expecting. If we do get to, let's say if we do get to around 4% for the terminal rate for the ECB for the main refinancing rate, let's say about 3% for the deposit rate, then that might be enough for the economy for the ECB to kind of see where things fall if inflation has been falling dramatically. But the Eurozone data has just come out of double-digit inflation. So it depends if there is more data that is needed to churn through to kind of understand whether or not inflation is continually falling or whether that was just a bump down and then we go back up a little bit. So that's one thing to be aware of, is there is that risk that inflation might last longer than or might be higher than expected or anticipated in 2023 than the ECB might think at the moment. So that could come through in the comments, that if they do expect inflation to be much stronger, than expected, which would be a bit of a surprise considering how recent inflation data has been, then that could add some extra volatility within the markets. Remember, the statement is very key for what the ECB says. Okay, if the interest rate decision comes in as expected, right? They may, even if the statement is what they say and also what they don't say, that can rock the markets, right? We'll go through it in a bit more detail of kind of what to expect. ECB minutes. So they initially, many members expressed preference for raising the benchmark interest rates by 75 basis points. Some argue that raising interest rates by less than 75 basis points would send the wrong message and run the danger of being seen as being at odds with 2% inflation target. The suggestion by the ECB's Elaine to increase ECB interest rates by 50 basis points was backed by the vast majority of members. So he was able to convince them, saying, "Hold on, let's take a bit of a back step here. Okay, let's not continue with these 75 basis point hikes." Saying his reasoning was that it would allow the governing council to tighten monetary policy for a longer period of time. And the consistency and time was seen as more important with restrictive rates. So once they get into the restrictive territory where they feel that they should be, then they can take their time with raising interest rates rather than continuing to hammer the economy with 75 basis point hikes or with super mega strong rate hikes. So Lane kind of calming the ECB members, if there was a bit of a quarrel between them, ensuring them that, look, we can still get to our objective. We can just take our time a little bit once we kind of get to the restrictive zone. Then if we carry on with ECB member views and what they also thought too. So Lagarde on the rate saying, according to the data, the next meeting will be 50 basis points. So already pricing it in for traders, and possibly the next one as well, and possibly the one after that. So, having talking about the expectation for 50 at the upcoming meetings is still in play, or could it be a 50 this meeting and then 25 basis point hikes and kind of taking their time with it? Fuel Fusion says, imagine if they did a 75. Yeah, imagine if they flipped the mark and said, hold up, it's time for a 75. Pascal David says, how can I get that draft you record news data of Bank of England? Yeah, that's in the mailing list. So I'll actually put the link out here for you. So if you want so that's completely free. Just sign up to the MacroAce mailing list. You get the deviations for the economic release, okay, in a PDF. You just click on a button on the email. And then you also get a summary of the week ahead of what to expect in Europe session, EU, US, and Asia session. A short summary, no big graphs or charts or anything like that. Short summary because the meat and the juice or the honey comes along with me talking to you guys like this in this way about the rate decisions or economic releases. Like tomorrow, we've got non-farm payroll. So if you send me an email, if you want the deviations for tomorrow's non-farm payrolls data, I can send that to you by email too. But further going back to the member fees as well, we've got about 15 minutes. Well, about 17 minutes. Villeroy says that will probably increase the pace of quantitative tightening from July. Muller said rates are likely to rise more than markets expect. Could that mean a 75? Oh, well, we don't know. Or could that mean a continuous amount of continuing with 50 basis point hikes for longer? De Gwendal says that increases of 50 basis points may soon become the new standard, and not estimates that the bank passed halfway point of tightening, according to the Financial Times on December 26th. So if that's halfway, then the central bank has got quite a bit of work to do if they're at 2.5% for the main refinancing rate and 2% for the deposit rate. So if he's thinking that we need to continue tightening towards 5%, that's quite a ways to go for the ECB. From one ECB member's view. Santino says rates are close to peaking if no further external shocks occur, like the Russia-Ukraine war getting worse, or maybe maybe a black swan event, maybe a tactical nuke is dropped, or maybe you have another scenario, another something else outside of the European Union that has an effect on the European Union. Holtzman said on January 11th, it's too early to talk about terminal rates, and Costa says significant interest rate increases are expected to continue. Knott says the ECB are planning to hike by 50 basis points multiple times. And Knott also said that there won't be 25 basis point hikes at upcoming meetings, but they could occur in the second half. And he said he wants at least 250 basis point hikes at least. Then the bets and expectations that we had. So Societe Generale says they raised the ECB terminal rate forecast to 3.75% from 3% previously. Okay. So an expectation. This is what happened with the Federal Reserve. The same thing. When the central bank started raising their rates, so did markets. So did investment banks and also traders start raising their expectations for where the central bank would end up, determined by where inflation is and how much of a fight they have left to do with that, and how the U.S. economy, or how the economy is performing. Overall. So with the ECB, I'm not surprised that you have investment banks raising their expectation of where the terminal rate is going to be. It's more of a, as I said, similar story to the Federal Reserve and their expectations for where the rate could end up, i.e. that it's continually changing and going higher. Goldman Sachs said the ECB is to hike by 50 basis points in February and March, and then 25 basis points in May. And they see the terminal rate at 3.25% in May. So if that's where they need to reach, then that could change depending on how quickly or slowly inflation declines, or maybe it creeps back up instead. So that's another thing to worry about, or that the ECB has to worry about, is how big are the external shocks going to be from the Russia-Ukraine conflict? And can they get inflation, and can the central bank get inflation down without causing a recession or a deep recession within the European Union? That's going to be key today, the comment. Do they stick with the comment saying they're expecting a relatively short-lived shallow recession, or do they become even more dovish and expect that a recession is going to last longer or would be deeper than expected? But these small bits of detail in the statement that comes through from the ECB can flip the markets just like that, right? On a couple of words on how it's kind of expressed. So we've got to be very careful as to what's been said from the statement too, rather than just looking at the rate decision. Traders also raised ECB peak bets by 16 basis points and priced at 3.35%. Rate by September. And January 3rd, again, traders picking up the pace. As I said, it's going to increase their expectations for what the terminal rate would be at 3.55%, down 1 basis point from the prior close. So this is ING with their expectation. Okay, so what is the base case for what the ECB could say for the inflation outlook, growth, interest rates, and quantitative tightening? It's very useful to understand what kind of comments to expect. Right, what kind of decision to be taken, and how that could affect the markets, whether that's seen as very hawkish. You can more or less kind of forget this little bit here where it says euro dollar and 10-year bond. Right? You can just kind of focus on what the text is saying and gauge that there could be an increased amount of volatility if you're looking at the low end or the dovish side, or if you're looking at the top end with the very hawkish side, or the moderately hawkish side as well. Could be an increased volatility, but still very useful to understand. So we're looking at if they go for a 75 basis point hike, if they decide to shock the markets and say, shock the markets today and ruin expectations, say, nope, we're going for a 75 basis point hike instead. If they do decide to do that, then, good luck to everyone, because that could send the euro flying if they do go higher than expected with their interest rate. So if you did see the interest rate going to 3.25% rather than 3%, Okay. And then the deposit rate can, if it goes to 2.75% rather than 2.5%. That will lead to the euro flying in the air, seeing a lot of strength, and that would probably could be backed up by hawkish comments too, or could have some dovish comments that come through, that you do see the initial jump from the markets, but if the statement is very dovish and saying that maybe 175 base point hike was needed, but they see that future risks are mounting up, that the economy could see a deeper recession or inflation will still be stronger than they expect, that could lead to more of a mixed reaction in the markets. But here's the very hawkish side. So inflation outlook dismissing recent easing in inflation, saying inflation is too high and requires swift action. So saying it's not enough, still gotta kick it down the can, down the road. In regards to growth outlook, balance of risks now tilted to the upside, outlook much improved. A 75 base point hike pushing against speculation, and PEP reinvestment may stop in 2023 rather than slowly later on down the line. A 50 base point hike if it's done as expected, but a worsening outlook for expectations. But saying that medium term inflation, or over the next 12 months or so, 12 to 18 months, that it may return to target earlier than previously thought. Worsening outlook suggests slower pace of tightening, and APP reduction can be paused if necessary. So this is basically a worse scenario presented by the ECB will lead to a weaker euro. Then if we're looking at the previous rate decision and the market reaction, we've got about less than 10 minutes left till the rate decision. This is last time round, same day as the Bank of England on December 15th. Looking at the Euro Aussie dollar, Euro JPY, Euro New Zealand dollar, as I had nice juicy reactions, or bigger reactions last time round. Okay. All right, so there was a hike as expected from the ECB. All right. And then what happened was, of course, the markets didn't move too much. Okay. Then you started to see if I kind of move forward a little bit more. Move a little bit forward. Then you start to see the euro seeing some strength movement towards the upside. And the reason being is because they said they see a short, shallow recession expected, and the ECB is to announce Fed meeting detailed parameters for reducing APP holdings. Okay, APP is the last bit of monetary easing that the central bank has. You have PEP for the pandemic, and APP is more refined for specific government bonds that European governments have, or European banks have a hold on. But here you can see the key. So you can see the euro, although it was an instant, you did see the movement towards the upside there, or for the back. And also the growth projections also seen as positive too. So no real expectation of very bad or negative data from the ECB to kind of scare the markets. So that was the last rate decision. If we look at the deviations then and how the markets had moved and reacted. So here we are. So you can see from the FDAX or the DAX, you had 43 ticks down. And after about 10 minutes of trading, it was still down by 80 ticks. So remember the first figure here shows you the initial market reaction move, right? Going to the wick of the candle. If it says down and then the figure here is just by itself, that means it's continued to stay down or gone further down, or vice versa, right? You can see here it was after about 10 minutes of trading to the end of the candle, right, on that 10-minute on a 1-minute chart, it was down by 80 ticks. Stocks 50 didn't see too much of a move. A little bit of move down, 22 ticks down afterwards. Euro dollar, again, not too. The currency pairs didn't see too much of a reaction. Okay, initially, but then afterwards, you can see that the euro started to strengthen here quite a bit, right? So the biggest reaction was on the euro New Zealand dollar and the euro Japanese yen, with the euro GBP and euro Aussie dollar. So the biggest reactor so far, last time when I said, was, to bring it up here, the euro New Zealand dollar consistently. It's always been the euro Japanese yen that's had the biggest market reaction because of how the Bank of Japan has been with their monetary policy. But like we saw this morning with the Bank of England, nothing, you can't really put that aside. So that's one thing I'm going to keep an eye out for, is the euro New Zealand dollar when we look at the market reactions. So if we do get something higher than expected, if we do get a 75 base point hike, then that could present a better outlook for the euro. Anything lower than expected, than a 50 base point hike, if we do get 25 today, then you'd expect a weakening from the euro. Now, I've also got to remember with bonds as well. If you have bonds, if the interest rate goes higher, bond yields will go higher, and bond yields will go lower in anticipation of a higher rate of interest, and then vice versa. Okay, and stocks won't like it in general if you raise interest rates much higher than anticipated. So you'd see a downside move from them, and also vice versa. But also the statement matters too. Don't forget that the language that's used, if they do expect a worse than expected a recession, or the economy to fare better than expected. So that's going to, again, that's going to be something to be aware of. So reducing the APP holding, it can be bullish for the euro dollar if they decide to cut it by, if they decide to cut it shorter, if they decide to cut it sooner, should I say, rather than later. Okay, or make sure it ends in 2023 rather than letting it kind of carry on with PEP at the same time. So, that can add to the positive sentiment, but it depends on what the rest of the statement says. You can't just rely on one thing of the statement and say, yeah, let's go. You've got to kind of look at the rest of it too, and see what the overall picture is presented, and then the markets will start to move, is one thing that could be is how the markets can react. Give me 1 second, guys. All right, less than a minute to go now. Just all tickety boo. Let's go. Let's see what we got. Let's get TICKSTRIKE up running. Had some issues earlier on with TICKSTRIKE. Should be fine now. There we go. Yeah. Right. Okay. So euro dollar. Okay, let's see what we have. So I do want to put up the bring that up to Euro New Zealand dollar. Okay, there we go. Because that did see the biggest movement last time. Less than 10 seconds. Okay, hike, 50 base point hike, 50 base point hike as expected for the interest rate decision. Deposit rate hike, 50 base point hike, 50 base point hike to 2.5% as expected. So there we go, as expected. Not too much movement from the market there. The Euro New Zealand dollar, or we're looking here at the bonds. Well, now if we're looking at the comments, that'll be interesting to see. Got quite a bit to go through. So let's see. They will stay the course in raising interest rates significantly at a steady pace, and in keeping them at levels that are sufficiently restrictive to ensure timely return of inflation to its 2% medium target. Let's see. So they're expected to raise interest rates further. They'll continue to be data dependent and follow meeting by meeting approach. Okay. Underlying inflation pressures, ECB intends to raise interest rates by another 50 basis points in its next monetary policy meeting in March, and it will then evaluate subsequent path of its monetary policy. So that being provided there by the saying that they're going to do another 50 at the next meeting is probably what caused that the euro to go towards the upside there for the expectations. Let's see. So with PEP, here we go. So in particular, remaining investments amounts will be allocated proportionally to share of redemption across each constituent program of APP and under public sector purchase program to share redemptions of each jurisdiction. Partial reinvestments will be concluded broadly in line with current practice. No. What do we got? ECB says, as communicated in December, APP portfolio will decline by 15 billion euros per month on average from beginning of March until the end of June 2023. Okay, and subsequent pace of reduction will be determined over time. Okay, so that's quite important too, is to get it, making sure it ends in 2023 is quite important there to understand. ECB today also decides on modalities for reducing Eurosystem's holdings of securities under APP. What else we got here? So that looks to be it, really. Yeah, that's it. In any case, they say future roll-off of PEP portfolio will be managed to avoid interference with appropriate monetary policy stance. Yeah, okay, that's it. Yeah, nothing else. More or less just saying the course. That's all. So key points, they'll raise rates by 50 basis points in March. They will also, with the APP bond holdings, make sure that ends. They'll do they will decline to 15 billion euros per month on average until the end of June 2023. So cutting that off sooner, or cutting that off quickly. So the markets, yeah, so Euro New Zealand dollar didn't see that big of a visually it did see a wick up, but it didn't look to hold that positivity that quickly. So actually all of them, if we're looking at the Euro GBP, nada was dead, and bunds, meh. Bund prices are going up off of the back of that though. So the expectation of continual rate increases. So the bond market is faring better compared to if you're trying to if you're looking at this move, this reverse we've seen on the euro, on the initial reaction. So that's what we can see so far on the bunds there. Still climbing. Let's do a bit of a measurement too. Let's see what else we got. Right, measurement time. How big was this move? So remember, always go to the wick of the candle, because that's gives you a better understanding as to how strong the movement was. Initial movement was let's go and see pips 14.3. Jeez, yeah, this one was a doozy. Yeah, 15.3, 50.3 pips. Your GP, yeah, I didn't really care, did it? That's nothing. It's 9 or 10 pips. Yeah. Let's look at the bunds. So there was the initial whip soaring there, but it's about 10 ticks. Should say, yeah, about 10 ticks there. Yeah, there was a little bit of movement towards the downside too, off the back of that, but again, candle ended up positive and had a wick to the top. Let's see. Yeah, right. So post the release, it's doing better. It's more with the ECB that traders are, like I said, the statement is quite important. So traders have digested the report itself, and that's how the market has reacted. The New Zealand dollar still has the biggest reaction. If we look at the Euro JPY, see what happened there. See what kind of reaction that had. If that had a similar reaction or not. Oh my gosh. There's no point of that. It's just, yeah. Okay. Well, Euro JPY, if you're talking about the initial reaction, it's about 17.7 pips towards the upside on the Euro JPY. So that had a bigger reaction than the Euro New Zealand dollar last time. But does the Euro Aussie dollar take precedence? If I can spell today. Right, let's have a little look. Let's see. We got it here. Okay. All right. No, maybe it's just edged it out. I need to be a bit more precise. More or less the same movement there. Yeah, you're not going to get. Okay, 17.9. So both of them had the more or less. No, you know what? I'm just be precise with this. Don't know how more precise you can get. Okay, just a little bit. Yeah, all right, the same. I don't know why I did that. That's pointless. There wasn't any point to do that. But yeah, you can see the Euro JPY and the Euro Aussie dollar had both the biggest initial market reactions out of a dead dud release. But the bond market had a better time compared to the currencies, as we can see here. All right, so that concludes the rate decision then from the ECB. Don't forget, as said before, we have FinancialJuice, where we had the data coming out live in real time as well. If you haven't had or heard of a live voice and text service, then the key things you need to know is something that the big boys or the investment banks have access to, or the big traders. Okay. Retail traders or the everyday smaller account trader doesn't really have access to it because it's not readily available to them, or they might not know of it, okay, or that much about it. So what it is, live voice and text service allows you to understand what's moving the markets. Okay, why is why the market is moving in a certain way? If a politician or central banker says something, of course we have ECB's Lagarde in about 15 minutes or so with the ECB press conference. She might say something that might rock the markets further, maybe, or give the euro something to play around with. Or there might be an economic release that might have happened or occurred that you might not have focused on if you weren't looking at the economic release data and you were just looking at the charts solely without kind of seeing what else is going on. If that works for you, then fine, great. But if you want to kind of maximize your trading experience and understanding of the markets and what's going on, then a live voice and text service is something that you more or less kind of need. If the big boys are doing it, why aren't you doing it? So you can sign up for free, right, on FinancialJuice. Okay, you don't have to go ahead and pay for the pro version of FinancialJuice. It's already pinned in the chat actually, so you can create an account. Now the free version has a delay on the website. There are adverts that play on the website too, but still the information is quite useful and it's still very good to have to use. Now, of course, to really capitalize on what the markets are doing and if they are moving and when, if there is a certain headline, then that's where you take, that's where it's better to, that's when it's up to you to take on the pro version of FinancialJuice and really maximize your trading. But again, as said, do whatever you want to do. Choose whatever you want to, whatever your choice is. But if you do decide to go for the pro version of FinancialJuice, first make an account on the FinancialJuice homepage, get an account and password, and then if you want to go for the pro version, as I said, totally up to you. There'll be a button here which says Go Pro. You can click on that once you've paid for whichever subscription you want of FinancialJuice. Then just go back to your homepage, log out, then log back in. And then you should see the page like this. Okay. There's also your need to know market risk as well, what to expect. Or basically what maybe things to expect in what could happen in the future. Okay, as in things to be aware of that could have an effect in the market in the future. Okay, for the day ahead. Usually the oldest headline that we have in there is 8 hours old. So for a trading session, you have your need to know market risk. Okay, so you more or less can keep up to date with what are the big things that have happened within the session and what could happen or could have an effect on the rest of your trading session. So that's all on FinancialJuice in one place. Okay, we've got initial jobless claims 2 in about a couple of minutes. If you want to trade initial jobless claims, you're basically looking for really bad figures for higher stock market reaction. Central banks will continue raising rates if they do see better than expected initial jobless claims report. Also, don't forget, we've got unit labor cost prelim and productivity prelim too. Unit labor cost is going to be I think it's going to be the key thing to look out for, considering how we had the ECI a couple of days ago, the employment cost index, and how that rocked the market with a 0.1% deviation compared to the forecast. We're just going to sit here and watch and wait for the see what happens with the spring of the ES. See what it does. I haven't really covered the initial jobless claims because one, you had the pandemic that meant that after the pandemic, releases didn't matter during the pandemic, other than the employment report, because that's what mattered at the time. Are people going? How soon are people going back into work, or how big is the job loss within America? So now economic releases, getting back some of their luster that they would have lost. Let's kind of see. Okay, it's about 10 seconds. So better than expected figure, not good. Worse than expected figure, great. Let's see. Okay, unit labor costs are down though. Productivity is up. Initial jobless claims 183k, and not that much of a deviation from 195k. So the markets, yeah, not seeing too much of a reaction there. There's EURUSD, yeah, okay. All right. Oh no, hello. There's a little bit of a pop. Okay, that's probably going to be off of the unit labor costs being lower than expected. Of course, that's another inflation measure for the US. So if that's continuing to see decline, then that'll be better for the US. For traders expecting smaller rate hikes from the Fed, or a pause, or at the most a cut later on in 2023. If that's still the expectation, you never know what could happen. They may decide to do one rate. May start to cut rates at the end of the year. Maybe rather than in 2024. All right. So non-farm payrolls tomorrow. That is the final release of the week that we have of MacroAce. As said, if you don't have if you haven't signed up to MacroAce, the mailing list, and you don't have access to the deviations, I can send that to you. To send an email to Tony at FinancialJuice. I'll put the chat in the I'll put the email in the chat again for you, so you can put that in for yourself, or you can send me an email and I'll send across the deviation to you for tomorrow. That's the live stream for tomorrow for non-farm payrolls, and then yeah, that's my email there as well. Okay. All right. Thank you very much for joining me. Don't forget to like the video, subscribe to the channel, share it too of the knowledge that I've shared with you guys. Hopefully you found it useful. But other than that, I will see you tomorrow at 8 a.m. Eastern time for non-farm payrolls. All right. Adios.